there's been a notable shift in sentiment over the last few days. In fact, global equities, US yields and the dollar have all weakened, have all come down. And that likely reflects the mix of political concerns, especially around the US administration's stance towards the Fed and other institutions, and also the weaker July labour market data that we had that may have undermined confidence in the US economy's resilience to these rising tariffs.
This is Converge,
a podcast from Canberra.
Come with us as we shape the future of finance.
Good afternoon, good morning, good evening. It is another Converge Market Update, middle of August, almost. George Vessey, good to have you back. Haven't spoken with you in a while. Great to see you again. Obviously, lots happened since you've been on the show. Markets moving fast. Really, the signals that investors and market participants rely on are really anything but clear these days. There's been surprise central bank splits and shifting trade flows and sort of a tug-of-war between this optimism and sense of what's actually happening in reality. So today we're diving into those cross currents and what it means for global markets. George, you're the lead FX and macro strategist in the UK. Help us cut through some of this noise and decode these biggest moves of the week. And, there's several tariff deadlines now behind us. Where do we stand in terms of actual deals versus missed opportunities? And have any of those outcomes rattled market expectations?
Hi, Alex. Great to be back. Thanks for having me. Yeah, it's been a hectic few weeks. No doubt there's lots to unpack as usual. But starting with the global trade war, as you mentioned, several key deadlines have passed. We've seen countries like Japan, the EU, South Korea. They've secured deals with the US ahead of that August 1st deadline. But they even ended up facing a 15% tariff rate. For those that missed the deadline, the White House rolled out a range of punitive tariffs. Brazil was hit with 50%, Switzerland with 39%, and India with 25%. That's now been doubled. The US-China truce, that was extended for another 90 days, which markets largely expected, to be fair. But beyond the universal tariffs, the Trump administration has introduced a new charge on companies exporting chips to China after having banned them last month, citing national security concerns. And it's a funny one, there's a dilemma here, because if these exports genuinely pose a national security threat, then surely no fee should justify allowing them. And if they don't, then why is the government actually carving out a share of the revenue? But what's more striking, I think, is how market sentiment has shifted from what was panic a few months ago to near indifference today. We haven't had a repeat of the volatility we witnessed back in April. And maybe that's because we haven't yet seen a broad impact on the economy, on corporate earnings. But still, with the average US tariff rate climbing towards 15%, levels we haven't seen since the 1930s, we're clearly entering a new era of significant trade barriers, and that's bound to weigh on global trade flows and ultimately economic growth and potentially asset prices in the future.
Yeah, interesting that financial markets initially shrugged off those August tariff announcements, but do you think they'll become more sensitive to signs of tariff impact on the US and other economies going forward?
Yeah, definitely. I think the full impact may be still months away, but we are already seeing signs that growth and inflation are being affected. And that points to a potentially trickier period for financial markets later down the line. There's been a notable shift in sentiment over the last few days. In fact, global equities, US yields and the dollar have all weakened, have all come down. And that likely reflects the mix of political concerns, especially around the US administration's stance towards the Fed and other institutions, and also the weaker July labour market data that we had that may have undermined confidence in the US economy's resilience to these rising tariffs. So yes, looking ahead, markets are likely to become more increasingly reactive to any downside surprises in US growth or inflation data.
So you say tariff impacts on the economy and prices are already becoming visible. Can you give us some examples of that?
Yeah, sure. Firstly, we've seen extreme shifts in US imports already distorting trade flows. So, for example, US import volume surged in the first quarter of this year to front run the expected higher tariffs that were coming into play in April. But volumes have crashed lower since then, and that artificially boosted US GDP growth for Q2, securing a 3% rise in GDP growth that quarter. And that was, as I say, artificially boosted by these by the drop in imports. And the biggest impact was that on China, where imports are down 50% from January, and China's share in US imports have halved since the start of the year as well. So it's clear there's a lot of scope for trade patterns to shift, and this is now a core planning challenge for businesses, with many turning to inventory buffers or alternative sourcing strategies to try and navigate these rising costs and geopolitical friction. And with regards to inflation, how much pass-through there will ultimately be from tariff increases to final retail prices in the US, it does remain uncertain at this stage. I think if we look back at a Fed study that found that the tariff rises back in 2018, 2019, they passed through quickly and almost fully to the consumer goods. And so far, we haven't seen that emerge just quite as quickly, but we are seeing signs of it. So the June PCE index, the Fed's preferred inflation gauge, that showed a sharp uptick. And then we've had today's CPI inflation data from the US that revealed that core inflation's rising the most since February to 3.1%, so further above the Fed's 2% target. So we are seeing signs of tariffs feeding through into the economy on both the economic data and the inflation data.
Yeah, so signs of inflation picking up in the US then. And I guess this is why the Fed decided to keep interest rates unchanged. But you mentioned earlier the weak labor market data for July. Do you think a continuation of this trend could tilt the balance toward Fed easing? I'm certainly seeing some betting markets out there leaning towards a substantially likely rate cut coming up in September.
Yeah, you're spot on. Obviously, the Fed's dual mandate to pursue both maximum employment and price stability, that often puts it in a tough spot when these goals start to conflict. So, as I mentioned, inflation may be picking up, but the latest jobs report was the weakest headline print since October. But the real shock came from the downward revisions we had from the previous month. That was revised down 133,000 jobs. That's the largest miss since the pandemic. And that means that the 3-month average gain now sits at just 35,000 jobs added each month. So again, the lowest since the depths of the pandemic. So it really casts doubt on the resilience of the US economy, or particularly the health of the labor market. As you mentioned, the Fed held rates steady. But what stood out was the dissenters of those of the governor of the policymakers. There were 2 governors who broke the ranks for the first time in over 30 years, and that's significant. And their concern was labour market fragility. So, given the latest data, it's hard to argue that they're wrong to worry. And indeed, markets have adjusted, as you say, to price in at least 2 cuts by the Fed this year, and potentially as soon as September.
Hmm. And Trump obviously wasn't best pleased with those labor market figures either, was he? I mean, we know there was the top labor employee was quickly dismissed in true Trump fashion. What was the fallout there?
Yeah, honestly, Alice, I think that was the biggest shock. Trump claimed that those jobs figures were rigged, as you said, fired the commissioner of labor statistics at the BLS, and that move rattled markets more than the labor market data itself, really. But what's puzzling to me is that Trump's been hammering the Fed for not cutting rates sooner, yet he dismisses the very person whose data could justify those cuts.
Yeah.
A bit of a self-defeating move there. But from a market perspective, there's no good way to spin it. Either the US data has been distorted all along, as Trump is suggesting, or the data was reliable and now it's being politicized. So both scenarios damage the credibility of federal statistics. And I think it's that kind of uncertainty as well that should translate into a higher risk premium for US assets, including the US dollar.
Yeah. So in the end, I mean, politics isn't just influencing monetary policy and global trade. It's really casting a shadow over the actual integrity of economic data itself, which is quite something. Well, what a whirlwind, I would say. George, let's just wrap up this crazy week. How's the dollar been responding to all of this chaos?
Yeah, sure. Well, before the jobs report that we had the other Friday, the dollar was actually staging a solid rebound. It was the top performing G10 currency in July. It posted its first monthly gain of 2025, a hefty 3.3% rise. Also recorded its best 5-day streak since September 2022. So it was making a strong comeback. And really, the short dollar trade had become so overcrowded that this bounce felt inevitable, but it was clearly helped as well by some renewed optimism around the US trade talks and the more hawkish Fed tone that we got before that labor market data. But as I said, that narrative flipped quickly. On that jobs report day, the dollar index saw its biggest one-day drop since May. It's already given back about half of its July gains. And if the Fed does lean as dovish as markets now expect, i.e. it does cut rates a couple of times this year, and if we do see US data continue to disappoint, then I think, of course, the balance of risk for the dollar is skewed to the downside.
So that jobs report really pulled the rug out then. Feels like the market's struggling to pin down a consistent narrative. Speaking of, I can't obviously let you go without asking about the Bank of England's meeting last week. What was the conclusion there and the impact on the pound?
Yeah, that was another real area of real theatre last week, Alex. The Bank of England's messaging was all over the place, really, cutting interest rates as expected, while simultaneously warning about sticky inflation. It's not exactly a textbook move, but adding more to the confusion was the vote split. It wasn't a united front. Initially deadlocked at 4-4-1. There were 4 members voting for a 25 basis point cut. One pushing for a larger cut of 50 basis points, and 4 wanting to hold rates unchanged. So that forced a rare second round vote. And obviously the 50 basis point vote has shifted to 25, tipping the balance 5-4 in favour of the cut. But the takeaway was clear that there were more hawks than expected, i.e. more policymakers voted to keep rates unchanged. And that therefore tempered market expectations for further cuts by the Bank of England this year. And that shift in market pricing helped the pound via the yield channel. But I'm not convinced about the pound strength in this situation, to be honest, Alex. It might not be sustainable from a domestic standpoint. This wasn't a confident cut. It was a cautious one, delivered in the shadow of stagflation, you might say, because inflation is still sticky in the UK. Growth is slowing and the labour market is softening. So at this stage, I'm not convinced the underlying macro picture offers much support for sterling's rally to continue. But then again, the dollar is driving the narrative at the moment. So perhaps sterling against the US dollar can continue to climb purely based on dollar weakness.
Yeah. Well, certainly interesting environment. Thanks, George. Great to chat again. We will touch base in a couple weeks, see what's changed, see if we're getting closer to any Fed pivots, and as always, an exciting time in the markets. Thanks, George. We'll talk to you soon.
Thanks for having me, Alex.